because it's a really interesting week when you have, as recent as last week, all-time highs in several equity index benchmarks, Mikey. This week, a lot of fear being put into the market, a lot of downside being seen, but concluding the week with a big bounce back, a really nice position for those people who maybe didn't see fear or risk entering the market last week. Today, seeing some of that downside action, but getting a nice big bounce to potentially put a hedge on into. A lot of people think like sell-offs and then bounce backs only good for speculators who maybe try to buy the dip or sell into that bounce, but a great move to look at a hedge here.
Yeah, and this week's move in the equities was kind of a nice reminder. If you're a subscriber, a community member at the small exchange, and you got the weekly newsletter and part of the market commentary that Frank put out, he talked about hedging a portfolio, especially an equity portfolio, as we were sitting at all-time highs from last Friday's close, where we broke all-time highs in the S&Ps. This week's move, kind of a nice reminder that if you hadn't hedged previously, maybe you want to think about incorporating a hedge going forward. This buy the dip mentality can only last for so long, not to be a fear monger. But today we're going to dig into some of the mechanics of actually putting on that hedge and how you can not only put it on, but manage it as well, which I think will probably become especially important in the next few months.
Yeah, because I agree with you. I will never, hopefully will never become, I got a lot of years left, but I'll hopefully never become the guy who's like, a crash is coming and you should all run for the hills. You're screwed. Get all your money out. Put it in cash and put it in gold. Like this, it's over with. The crash is coming next week or maybe the week after. I don't know, but it's coming. I don't think either of us want to be that person. But this is a good reminder that like when the stock market moves to the downside, it moves, and like you can easily erase, especially the trend that we've been on the last several years. It wouldn't be out of the question, Mikey, for the stock market to erase 10 or 20%. In the matter of a week. And so a good reminder here, we're back near those all-time highs in several stock markets, but this whole week, all the volatility, all the news coming out around pandemic woes, we got a bunch more data releases next week and on down the line for the rest of the year here. A good reminder that you might see some downside, and let's get into what might trigger a hedge, because this is one of those things, this is like something that I live by in trading and finance and honestly just like life in general. A lot of people tend to think of like big ideas such as hedging or big processes like for instance, like I'm getting to the age where like maybe it makes sense to stop renting and I should like buy an apartment or something like that. And people think about they tend to think about these things as like, wow, that's a big idea, and like I need like some kind of professional to come in and do this for me because I don't know how to do it. And hedging is a similar one of those ideas where it's like, until the last couple of years, even the most active traders are like, well, I need a financial advisor to teach me how to hedge. And you really don't. And the starting point is usually like, well, when should I hedge? Whenever you perceive risk in the market. Like it's as simple as that. There is no financial advisor over at Merrill Lynch or anywhere else that is going to be able to predict the best time to hedge. And the best time to hedge theoretically would be the day before a stock market crash, like the all-time high in the stock market before it turns over. No one's going to be able to if you could predict that, then you'd be golden. Like you'd be able to make a ton of money on both sides of the market. But Mikey, it's as easy as just like looking at whatever might help you to perceive risk in the market. Here I have the VIX index, which is starting to tick higher. The skew index, which actually is starting to come lower, which is like that outlier risk index. Just as a couple of measures there, but it can be as simple as like the stock market has unsustainably moved higher and I perceive risk, right? Like it's up to you when to commit a hedge.
Yeah, and you put two of my favorite indexes here. Three, I guess they're all three of my favorite, but two really important ones, VIX and skew. So for people who aren't as familiar, these are measuring basically option prices on the S&P 500, but in two different ways. So VIX is measuring the general prices of options on the S&P, The higher this index, the more fear kind of perceived in the market. And skew moves a little differently than VIX. It measures what the out of the money options. It's like the puts versus the calls. Frank, am I maybe getting
Yeah, it's
that
like
correct?
far out of the money puts. Like it's like outlier risk essentially.
With the idea that big portfolio managers or even traders or informed traders are buying these out of the money options or trading them at least because they're expecting some
Mhm.
outlier moves. So two neat ways to kind of try and forecast or get a feel for if markets are turning or not. Other people look at 210s in inversion there and interest
Sure.
rates. There's a whole bunch of things you can look at. But going back to your point, whenever you feel there could be a sell off in equities, is the time to put on a hedge. And you don't need a super advanced financial calculation to derive your hedge or to find the perfect time to hedge. There's a lot of very simple things you can do, like sell certain option spreads, buy certain option spreads,
Sure.
or use futures contracts, which you can buy and sell just as easily either direction to hedge your core portfolio.
And we'll get into using those futures obviously here in a second and get into like the full, like the anatomy of this hedge starts with that idea of like when it
Mm-hmm.
comes. I just want to conclude that section of this anatomy with like with a funny story that I picked up when I was interning at a wealth management firm where you have these dudes who are like who've been in the industry for decades and they're managing millions and millions of dollars, and they're talking about, I'm there as a summer intern, they quite literally were talking about taking risk off the table or hedging positions going into the fall because colloquially there's more volatility in the fall. And it's like that that's
When
not
the
even
moon
like
is full on the eighth month of the year.
exactly right. And it all comes from the skewed average VIX reading because one of the biggest crashes in the last 50 years occurred in the fall of 2008. And so that just skewed their thinking. And now they're making big decisions worth millions of dollars of hedging investment off of just something as simple as that. So like it can be, which isn't to say like that's necessarily a bad idea. I don't want to throw shade on anyone, but I hope that empowers people to be like, hey, I think next week's non-farm number is going to be a volatile one. I'm going to hedge for the next
Mm-hmm.
week. Like it's really as simple as that. Or yeah, like this Olympics that's coming up looks like it really might be like a benchmark for new COVID woes. Like, I don't want to have as much equity exposure going into this Olympics that as news comes out about, I mean, Japan going on lockdown, more countries might need to do that. Like that
Mm-hmm.
type of stuff, like it can be as simple as that, or you could use
Mm-hmm.
some of these technical measures that people are used to seeing. Mikey, let's get into it though, okay? Because here's where you go from idea to execution, and it's the amount of risk lending that to your portfolio. And I like the way that I laid it out here. I'm interested to see what you think, Mikey. But like, okay, I think now is a good time to hedge. I perceive some risk in the market. Is to me, it's as simple as like scale of 1 to 10, dude. Like, how much risk do you perceive in the market here? It's like as simple as like a Google survey. 1 out of 10 being a 10% hedge, 7 out of 10, 70% hedge. And you can go all the way to 10. Like, holy crap, I think the stock market is going to crash. That just means that you hedge 100% of your portfolio. Am I wacky with this idea of just giving a rating to the risk you perceive in the market?
Yeah, I think this is a nice, clean way to do it, actually. And if your hedge, 10 to 100%, the amount that you benefit from your hedge is going to be proportionate to that amount. Obviously,
Yep.
a 100% hedge, you're going to be a little more protected than 90%, 80%, et cetera, et cetera. I also like this as well because it doesn't mean you have to hedge everything. Like you should have the freedom to choose. If you just think maybe there's going to be a little bump, a short-term opportunity, you sell some SM75 going into a
Mm-hmm.
non-farm payroll or an event-specific risk, you can do that as well. And just expect that your core portfolio is going to ride out smoothly after that event is over. And maybe the risk on trade only lasts a few days. So you can be very flexible there with this approach.
So yeah, you take that rating 1 to 10 there, And yeah, if you perceive zero risk, zero, you got zero hedge. No reason to throw any hedges in there. But you take that percentage, Mikey, you apply it to your total investment there, and you can
Hmm.
essentially ballpark it and be like, all right, well, I've got, 20,000 in this one application. I've got, another 30,000 in my 401k. Like just kind of like put together all your exposure and then look at the small exchange, small stocks future, which is a pretty universal barometer of the stock market. It's got energy stocks, technology stocks, industrials, financials, and on down the line. Multiply that price by 100 and use this formula to output how many of those smalls you should be selling. Now, let's get to that actual selling piece here. Right now, at around $7,500 per contract, a price of the futures around $75 times that 100, you sell the number of SM75s that get close or within a rounding error there of your hedge amount. So, Mikey, I want to use, for our sakes here, we're pretty good at math, but we're not nearly as good at math for me to be like, we've got an example account of $132,000. No, that'll be like so freaking hard. I don't want to do it. Let's say we have $75,000 all in stocks somewhere, stocks, ETFs, and everything else throughout however many accounts you have. That would mean that every notch on that rating curve from 0 to 1 to 2 all the way to 10 is just one short contract in the SM75. And maybe, Mikey, you can walk through how this works. Like if I hedge 10% of my $75,000 portfolio, that's one short SM75 contract. If there's a 1% fall in the stock market, then I should lose $750 on my total portfolio investment. But I save myself $75 in the SM75 hedge. And guess what? That's 10% of those losses. That's how this works. Like take it all the way to 10, Mikey. If I hedged with 10 short futures, 100%, and 1% of my portfolio fell and the SM75 fell, what happens?
There you go. So yeah, you're hedged 100% there. So you'd expect that offset in your short SM75 position to be the full amount that you lost in your portfolio as you're 100% hedged there. Nice, clean example. Kind of fitting that the multiplier on SM75 is 100. Makes the math a little bit easier to derive your notional exposure there. But yeah, you nailed it. So that whole spectrum between 1 and 10, you choose how much you expect your hedge to benefit when the market does take a turn in your core portfolio there.
Yeah, absolutely. And so with that, it would be 1% fall, $750 in losses in my portfolio. But I got 10 SM75s. They all fell 1%, $75 each, $750, blocked out all of the losses there. Same to the upside. If I put on a hedge of 10%, one short future here on my $75,000 portfolio, Mikey, and everything climbed 1%, then my portfolio made $750. Sick. My hedge lost $75. So my total net gain there is $675. And so it works in both directions, obviously. And the last thing I always say is don't hedge 110%, 120%, because then that's the only way that if stocks move higher, which is what you want to do because you bought all these stocks, you're losing now. And so it's really as easy as that when the stock market moves in either direction and you're hedged between 0 and 100% there using these futures. And futures, by the way, are the most straightforward, the most cost-effective way for you to get these hedges on. I talked with our mutual friend Jamal, Mikey, and he was talking about buying puts and selling calls and something like that, though it can be more creative and you get, maybe theta exposure and all these different things, Mikey, as well as I do, if my $75,000 account rose 1% and I have some short calls on in SPY or something like that, it's like, I have no clue what I want to happen. It's very confusing very quickly.
It's always pitched buying puts as like the classic portfolio insurance, but it's never cut and dry. I mean, you're dealing with adjusting exposure amounts because your deltas are changing as the underlying price moves. You're dealing with time decay and theta, whether you're short or long options, it's part of your portfolio hedge and it's going to impact how well you do. There couldn't be a cleaner way with futures. I mean, that's kind of the origination of the contracts was for hedging purposes. So why not use them today in whatever your portfolio size is?
Absolutely, absolutely. I'm glad you brought that up. That was like for people producing agriculture products or banks looking to hedge, stock exposure, foreign exchange exposure. That's what futures were by and large created for, is a cheap way for you to get your hedges on. But also, Mikey, a very easy way for you to take them off. Like once that market moves up or down 1% or 3% or 10%, or just whenever you're like, the market could go sideways next week and you could go through, that number you were worried about or that event that was coming up that you were worried about. There's no change in your portfolio in the stock market at large, and thus no change in your hedge. And you can just take it off. That's it, man. Like it's really as simple as that. When the risk that you perceived is gone, you could take that hedge off. Also, say you thought that there was a ton of risk in the market in the next week, so you hedged 50%. Oh, there's still risk out there, but not as much. Take off two of those contracts, you're hedged 30%. It's so easy in futures to just buy and sell these things intraday, day to day, week to week, month to month. And that's the ending of this hedge, is when you think the risk is gone, you just take it off. Easy as that, right, man?
I mean, chances are you're going to take the hedge off and then the market's going to crash.
Don't say that.
I'm just kidding, because no one knows, right? But the cost, point being, the cost to maintain these hedges is so low. And because you're not using options, you're using static deltas, you also don't have to worry about trying to time it perfectly. So you can always maintain a 10% hedge if you want. It's going to redact a little bit from your profits if you're long stocks, for example, and stocks continue to grind, but at least you're muted against a huge, a downside move.
Exactly right.
Great stuff.
Yeah, you don't lose that exposure like you do with the short call. You don't have to pay for that exposure and premium like you do with the long option. And when you talk about low costs, futures have the most efficient margin of any derivative out there. And so for each of those contracts, Mikey, as of today, you have to pay just $750 for $7,500 worth of hedge, and the fees from the small exchange. You actually corrected me on this. They're 15 cents.
That's correct. And if you're a community member, they're just 7 cents.
That's exactly right. So yeah, go to subscribers.thesmallexchange.com to check that out and all the content around hedging and everything else. This has been a blast, Mikey. Thanks so much for joining me here on Friday afternoon. We've got Pete's outside. I know you've already dipped your, what is this? The colloquialism is dip your pen in ink or dip your toe in like the water. But how do you lend that to food? Like dip your stomach in pizza? What is it?
I just had like 2 slices of deep dish before this, just tasting it, making sure it's not poison. We're all good here. We can eat it.
That is the most classic thing. Did your parents do this? I remember my dad doing this. Like if we got ice cream or milkshakes or something like that, it would always be like first, like I can see him right now. Like I'm in the back seat and we're like pulling up to wherever, and he is like getting ready to pass the milkshake back to me, but he takes a big swig of it and then passes it back. I get angry and he's like, I'm testing it for poison.
Yeah, for me, it was my Pepe. My grandfather always said that one. He was, a smart guy. He would say, like, you're my favorite grandson from this city in this town under these parents with these many siblings. So he wasn't excluding anyone. He was just being very, very specific. He had all these neat ways to hedge himself, his language.
Well, I appreciate that, because that makes him not a liar. Like my dad just lied. It was like he wasn't testing it for poison. That was all. He was full of it. And so like at least your grandpa was speaking truth. He was like, yeah, you're my favorite grandson, Mikey, from my daughter or son or whatever the hell. And it wasn't a lie. So good job by you, Grandpa Goff, or maybe it's your mom's side. I don't know. We don't need to get deep on your family tree right now, man. It's Friday afternoon. Go enjoy some more pizza. I'm going to be sticking around for Splash into Futures coming up next. Everybody hang around. We got some trading left to do here on Friday afternoon. Thanks for watching.